We'll now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas, for 5 minutes.
Thank the Chairman. Thank the Ranking Member for this prompt hearing after these weeks of tumult, and thank the panelists for being here as well. Mr. Barr, when were you nominated for your job?
I apologize. I don't have the date in my head. It was the spring of last year.
And do you know when you were confirmed for your job?
Yes, I took my post up in July of last year, July 2022.
July of 2022. So between January 20th, 2021 and July of 2022, who was in charge as Vice Chairman of Supervision at the Federal Reserve?
There was no Vice Chairman for supervision during that time period.
And so when that happens, what's the Fed's process for delegating that authority to another member of the Board of Governors or a staffer, or how does that work?
I apologize. I don't know the technical answer to that question. We'll have to get back to you with a written response.
Yeah, if you get back to me, because what we're saying to my colleagues here is that from the turn of administration, we did not have a Vice Chairman of Supervision from January 20, 2021 until July of 2022, and that is precisely the time frames, colleagues, when this bank's business strategy went awry and was under this supervisory concern by the San Francisco Fed. So I just want to have that in the record. And when I look at the results of this bank and the UBPR, the call report data, and looking at your good testimony about the timeline that you've disclosed, it appears to me that we have a lack of supervisory urgency here. You outline that the trends in 2021 are what triggered concern by the Federal Reserve examiners, and I assume the state of California. We haven't heard from the state of California. We'd like to. But there was an exam in the summer of 2021, and then it took till the fourth quarter of 2021 to tell the bank we had some specific serious concerns, so that you met with the board then, not you, but the supervisors. And then the downgrades didn't come, and those tough visits didn't come till the summer of 2022. So really 12 months of discussion between the board and the state of California and the San Francisco Fed. That doesn't sound like a very urgent supervisory process. What is it? Do you consider that urgent to take a full 12 months in that process?
Mr. Hill, I think you raise an absolutely essential question. It's one of the things we're going to be asking in our review. Obviously, these events occurred before I arrived at the board. I'm going back and looking at what steps were taken and not taken. And I think it's a completely fair question. Should the supervisors really, been much more aggressive in the way that they responded to the risks that they saw and they were noting? And we're going to look carefully at that.
Yeah. I just was shocked with the business plan, way out of line with peer. You have matters requiring attention, which is a very low level, the lowest level editorial comment by a bank regulator. There was no proposal for a board resolution that I saw in your notes. So I look forward to the results of your comments. On this issue of Dodd-Frank versus S-2155, my reading of bank law, just those things are just almost not important compared to 12 U.S.C. 1818 on cease and desist, where the FDIC, the primary bank regulator, the state can do whatever they want to a bank that's not operating in a safe and sound manner. Isn't that right, Mr. Barr?
The bank regulators have substantial discretion to use those authorities
right
when banks are operating in an unsafe and unsound manner. I agree with that.
And I thought Senator Crapo's comment yesterday was very, very important, that in the rule of construction, that final bit of information in S-2155, the bipartisan bill, bicameral bill signed by President Trump, it says nothing in this bill shall be construed to limit the supervisory authorities for safety and soundness in any way. Isn't that what that rule of construction says?
Yes, I agree with that. I think we have substantial authority under existing law to regulate firms and supervise firms in a way that is appropriate for their risk and size and complexity.
Thank you very much. Mr. Chairman, talking about the resolution process, are you open to a full investigation, not only of the deposit insurance and not only of the supervisory process, but also look carefully at the resolution process itself?
Yes, Congressman.
And are you going to conduct that yourself, or would you work with us on that?
Well, we would certainly be prepared to undertake that review and be transparent with you in regard to it.
Something I want to see considered, and I argued this back in 2008 as a private citizen and banker, which is in the resolution process to consider non-bank buyers for these assets. Do you agree that's important? We should consider that?
Yes, it is, Congressman.
Thank you. I yield back.
We'll now recognize Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Mr. Barr, the rescue of depositors in Silicon Valley Bank demonstrates that regulators think banks like Silicon Valley pose a systemic risk to the system, just like Gypsy do. Mr. Barr, don't you think Category 3 and 4 banks should face the same rules as the mega banks?
Thank you very much for that question. We are looking at capital and liquidity standards for all large banks, including firms 100 billion and above. I still think a tiering approach makes some sense. It doesn't have to be the same rules for all banks, but we do need stronger rules for firms of this size. Stronger rules on capital and liquidity, I think, are going to be really important.
Mr. Barr, in my view, the decision to insure all depositors was a necessary and correct step. However, I am frustrated that time and time again we fail to regulate them like one, and as a result we find ourselves in situations like the one that we are currently in. Without proper regulations that account for the systemic risk profile of a bank, we are incentivizing bankers to search for yield and inviting moral hazard. Mr. Barr, the sudden and immediate collapse of Silicon Valley Bank demonstrates the vulnerability of banks and the broader system to interest rate rises. Yet, under our current capital rules, most banks are not required to recognize this risk, only GSIBs. Will the Fed rewrite its rule to require all banks to account for interest rate risk?
You raise an absolutely essential point, and one that we are very carefully looking at. We anticipate engaging in a notice and comment rulemaking process on capital rules with appropriate transitions, and that is one of the areas that I think would be important for us to consider in that rulemaking process.
So do you think that the rules passed under S-2155 and written by the Trump administration need to be rewritten?
We're going to look as part of our review at not only our supervisory issues, but also at the regulatory structure that the Federal Reserve put in place in 2019 and see whether the size thresholds we used, the standards we decided to put in place, all of that is on the table. We're reviewing that. We're going to come back and provide an assessment of that on May 1st.
Thank you. And Mr. Barr, the Fed has been raising interest rates more rapidly than it has in decades in an effort to lower inflation. It appears that many banks were unprepared for this. Can you explain how the Fed's bank supervision staff coordinate with its monetary policy-focused staff to ensure that banks are properly prepared for well-telegraphed shifts in monetary policy? Does the Fed see regulation and supervision as separate from monetary policy?
The whole of the Federal Reserve staff communicate very well together. As you noted, the monetary policy decisions were very well telegraphed. The decisions were essential to meet our congressional mandate of price stability and maximum employment. And we need to make sure that we continue to pursue that. We have separate tools that we use, of course. And as I said in other contexts, interest rate risk management is a core bread and butter issue in banking. It's not an esoteric issue, an exotic issue, a complicated issue. It's a straightforward issue, and the bank management failed to do that here.
Thank you. And during his news conference last week, Chairman Powell said that the FOMC considered a pause in the interest rate increases in light of the recent banking failures, but ultimately unanimously approved the decision to raise rates due to intermediate data on inflation and the strength of the labor market. How will the Fed balance its supervisory role with its monetary policy role as it considers future interest rate increase?
We have really all the tools that we need on the macroprudential and microprudential side to assess financial stability and bank safety issues. And as I said, the banking system overall is sound and resilient. Deposits are safe. On the monetary policy side, we're going to be looking at incoming data. We're going to be looking at changing financial conditions, and we'll really make a judgment on a meeting-by-meeting basis about that decision.
Thank you. Mr. Chairman, I yield back.
We'll now recognize Mr. Sessions for 5 minutes.
Mr. Chairman, thank you very much, and thank you to the witnesses for being here today. I think you see that this committee will work together, has questions, and would wish to hold you accountable, but I must confess to you, after hearing the questions that have taken place, I've heard none of you three accept real responsibility for your role in this endeavor. I've heard that you were aware of it the week of. I've heard that notice was given of oversight back in 21, that a frailty was noticed. I've heard us say that we used all of our tools. I've heard you say things like the FDIC will use all of its authorities. But I've not heard any of you three talk about a systematic failure to let the bosses know what's happening. I've heard you use, well, this got staffed and that got staffed and staff did this. I think this is a wake-up call to all three of you. I hope it's a wake-up call to your organization, that evidently they can see these bread and butter failures back in 2021, but evidently nothing realistic ever occurred to avoid what seemingly anybody that's a professional banker could see. I've seen excessive regulatory oversight by this administration across the board. I've seen a lot of what I would call inattention by decision makers. So I would specifically tell you that we will drill down on and need to know more about the recommendation for systematic exception that was invoked. In other words, that was invoked by presumptively the people at this table, and yet it took all this time to filter up before you were even aware. Failure was occurring, and then you were given notice. So I would hope, myself, that there would be some inward thinking about your actual roles. Instead of staffing everything and waiting for it to bubble up to you, that there should be hooks in place. I spent 16 years in the private sector, ran a large organization, over 700 employees. I had more than a fiduciary responsibility, I had a managerial responsibility to report up the things that we saw to a very large organization. And I believe, by and large, those people welcomed my feedback and set ourselves up for that. So take the remaining minute and 50 seconds and give me some inward thinking, because I heard no one say, we were part of the problem. We need to look at us being part of the problem, and we need to be a part of the solution, because, as was noted, this will be paid by all banks across the country of the FDIC. Please. Mr. Barr?
Thank you very much, Mr. Sessions. I agree with you. I think we need to take a good, hard look inside at the Federal Reserve, at our supervision, at our regulation. I think we need to be humble about that. And I think we are going to be unflinching in our review about that.
Does that include your role?
Absolutely. Absolutely. And I'm here today to be accountable to you for that purpose.
Well, accountable is one thing, but coming back and actually admitting that you were part of the systematic failure is an entirely different process. People say, well, we'll hold accountability, but actually it's banks that are across the country that play by these rules and offer this money are the backstop. And while I don't want to argue against that, I do want to say I believe there's lots of room to say someone should have caught this as early as and done something back in early 22. Chairman?
Congressman, I really don't mean to shirk responsibility here. I think we share responsibility. I think bank management had responsibility. I think we as the regulators of the institution had responsibility. I think we're going to conduct reviews to get the facts as to what occurred and a measure of internal as well as external accountability. My own sense here in terms of the supervision of these institutions from my perspective is that both agencies, and I would include ourselves, were aware that there were issues at these institutions and trying to address them through the supervisory process. It's also my judgment, I think, and we're going to conduct a review to get all the facts here, if I may say.
The gentleman can answer the rest for the record. With that, we'll now recognize Mr. Sherman of California for 5 minutes.
Due to Dodd-Frank, our banking system is strong. Our regulators avoided a crisis by quick action this month. But the solution was not free. Some $22 billion of special assessments will be imposed on banks. That will lead to lower rates on certificates of deposit, perhaps 0.25%, perhaps 0.125%. And our entire economy has been hurt. It's been rattled by what happened this month. Our bank regulatory system has some real flaws. It's an undemocratic system in which FASB writes the accounting rules and doesn't even claim to be part of a democratic government. The Federal Reserve Board's regional banks, it's not one person, one vote, it's one bank, one vote. The bankers vote on who's on the regional board, and the bankers of my state elected the CEO of Silicon Valley Bank. Banks get to pick their regulators, state or federal, holding company or no holding company, Fed or OTC. They can use regulatory arbitrage, and every regulatory agency knows that if it gets a reputation of being too tough, the banks can flee and go to one of their regulatory competitors. Our accounting system for banks is absolutely perverse. If you make a Main Street loan, you're penalized under the CECL system, and you will always list that loan on your balance sheet as being worth less than you paid for the note. If you instead go to Wall Street and buy long-term bonds, you are rewarded. If the bond goes up in value, you can sell it or classify it as available for sale and recognize a profit and justify a bonus. If the bond goes down in value, you can hide it by listing it as held for maturity and list it at the original purchase price on your balance sheet, even though you know it's worth 20 or 30% less. The crypto billionaires fanned the flames because they understood that if they can besmirch our banking and dollar system, crypto goes up, and they've made tens of billions of dollars. Silicon Valley Bank could have saved itself in 2022 by hedging its risk or selling its long-term bonds, but they knew that would cut profits and bonuses. They decided to take the risk, and here we are. And of course, our clawback provisions are inadequate. There's $600 billion of unrecognized losses on the balance sheets of American banks. That needs to be juxtaposed with the $2.2 trillion of capital American banks have. So we're overstating the capital of our banking system by perhaps a quarter. Mr. Barr, particularly watched your Senate testimony in which you basically said it was bank mismanagement for them to ignore the good advice your people gave them. It is also misregulation to let banks ignore that advice. You are not running a consulting operation. You are running a regulatory operation who can force banks to follow that advice. And interest rates go up, interest rates go down. Certainly the Fed in auditing banks ought to know that, especially when this is not a 100-year event. Interest rates go up, interest rates go down. I mean, 2023 has its peculiarities, but it's particularly ironic. It's the Fed that's raising the interest rates, and then the Fed that's not examining banks to see if they can survive if interest rates go up. The concern we all have is, are there other banks that could go under because they invested in long-term bonds that aren't worth as much as they paid for them? So I'll ask Mr. Gunberg and perhaps Mr. Barr, are there any banks out there, and roughly how many, that have capital of under 5% if you subtract from their stated capital their unhedged, unrealized losses on long-term debt?
Congressman, that's a fair question and a factual question. If I may, let us get back to you on that. We'll get the numbers and share them with you very quickly.
And please don't give me the names. Mr. Barr, do you have any other answer?
No, sir.
Mr. Gunberg, I know that you're going to be giving us a report about possibly expanding FDIC insurance this spring. I look forward to it, and I hope that you would consider $3 million of coverage, but only of non-interest-bearing accounts. Because when a bank is used as a utility for a checking account, we need that coverage. If people are making investments, we ought to be a little bit more careful.